Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. It was a mixed day on Wall Street. Despite investors getting the news they wanted a first Fed reserve rate cut of the year. At the end of the session, the Dow did end higher. The S&P and the Nasdaq ended the day in the red. There may be a dash to refinance as mortgage rates drop to recent lows. We're speaking with an expert about what to expect following the Fed's rate cut. And the class of 2025 is helping define the health and wealth of many American cities. We're taking the best talent hubs across the U.S. Well, mortgage rates falling to their lowest level in nearly 3 years on Monday, dipping to 6.13%. That's according to Mortgage News Daily. That's sparking a surge in refinancing, but the monthly cost of owning a home continues to climb. We're breaking down what it all means with the Fed cutting interest rates by 25 basis points on Wednesday. Joining now, we have Daniel Hale, chief economist at Realtor.com. Daniel, it's all good to see you. Let's start with that Fed decision. Curious, Danielle, what you made of it, what you think it means for the 30-year fix. Just looking at Mortgage News Daily right now, they've got that at 6.22%, Danielle.
Yeah, thanks for having me, Josh. It's great to be here. So we had a big decision from the Fed today, but as big as it was also pretty widely anticipated. We know that the economy has cooled, especially the labor market, and the Fed has had its foot on the proverbial monetary brakes for a while. It's not so much slamming on the gas, but it is easing off that brake as the economy gets to a point where it doesn't need to worry perhaps quite as much about inflation and maybe needs to focus a little bit more on the labor market side of things. Now, what that means for mortgage rates is that we've already seen them come down much lower in advance of this decision today because it was so widely anticipated. I don't know that we're going to see a whole lot of additional movement lower because I don't think the Fed was overly forward-looking in its decision today. And it's clear from the projections that there's a wide range of views on possible outcomes. And the market has already baked in a lot of potential Fed rate cuts over the next several meetings. So I don't think we're going to see a lot of additional benefit. The Freddie Mac data that's out tomorrow was largely gathered before this Fed rate cut. So I do think we'll see those rates move lower. But as far as real-time rates that buyers or refinancers are going to get quoted, they're probably going to be roughly in line with where we've seen them for most of this week.
So can we put a number on it, Danielle? As an economist, where would you forecast the 30-year fix, let's say 12 months from now?
12 months from now, I think we'll probably still be in the low 6% range. So not a whole lot of additional easing. If we see a more substantial economic deterioration, I could see us move down into the high 5%. But with an economy that progresses, bumps along, avoids a recession, I think we'll be in the low 6% range.
And low 6, Danielle, would that spark meaningful activity?
I think so. We saw this roughly a year ago when mortgage rates got down to roughly 6.1%, almost exactly at this time last year. We saw existing home sales pick up as we moved into the later fall months, and that uptrend continued all the way into the new year. So I do think this is low enough to see some pickup in mortgage rates. And already we've seen an uptick in mortgage purchase applications and also in refinance applications, according to the mortgage banker data that was out today. So I do think we'll see a rebound in housing activity, perhaps not quite as strongly as if mortgage rates moved lower, but it is enough to jumpstart activity.
We talk a lot about the Fed, Danielle, and their impact on the housing market. What about the potential moves the Trump administration could make? We've had folks on the show say, listen, there's levers they could pull. They say, listen, we could see more deregulation. They could do more to boost supply. What do you think of that?
Yeah, at the end of the press conference today, Chair Powell got a question about housing affordability. And, he sort of rightly said that there's only so much the Fed can do about housing affordability. One of the big challenges facing the housing market right now is a shortage of homes that have been built over the last decade. Realtor.com has an estimate that puts us right around a 4 million home shortage. And that's not something that the Fed's tools are really well equipped to solve. Policy, however, not just federal policy, but including federal policy, is better equipped to address those challenges. We've got to make it easier for builders to build, whether that is cutting regulation and red tape at the federal level, or perhaps even more importantly, at the state and local level. That will help make it easier for builders to build and create more housing that can help bring down that pace of home price growth that has been really rampant the last few years.
Sticking with Trump, Danielle, what about tariffs, deportations? How are those policies impacting the housing economy?
Yeah, so from a policy perspective, the Trump administration has been a bit mixed. So the immigration policy has led to reduced labor supply by most estimates, and that does create challenges for home builders and the building economy. Now, on the other side, tariffs have been, hit or miss on, in some cases, building materials have been accepted from the harshest tariffs, but there are still tariffs that are affecting a wide swath of building materials, and that's making it more costly to build. And of course, the variability of policy is making it more challenging for builders to plan. So all of those things are sort of counteracting some of the administration and Congress's other housing moves designed to make it easier to build. So it has been a bit of a mixed bag so far.
Final question, Danielle. I know we've been talking here about housing on kind of a national level. Are there important regional differences you would call out right now?
Yes, absolutely. In fact, our latest housing trends report focused a lot on how the Northeast and the Midwest continue to be relatively competitive, relatively hot. Many metro areas in those regions are still in sellers market territory, so they're relatively favorable for sellers. But in the South and the West, we're seeing a lot more homes for sale, a lower buyer activity. And so those markets, 7 of them, in fact, have shifted into buyer's market territory. Nationwide, we're in balance, but it really depends on where you are as far as the conditions you're going to see on the ground.
Danielle, always good to see you. Thank you.
Good to see you too, Josh.
The tokenization of real-world assets is accelerating and is expected to grow even further. Yahoo Finance's Ines Ferre joined us now with more. Ines.
Yeah, Josh, and first let's start with what is the tokenization of a stock, for example. That is basically a stock which is issued on blockchain. That's the same technology on which crypto is based. Industry insiders I have spoken with have said that eventually you will see the entire financial market run on blockchain. You started to see this with stable coins, and then now we're starting to see it with equities. We've heard of the announcements of Robinhood introducing 200 US tokenized stocks in the EU. Gemini also offering tokenized stocks in the EU. Those are more derivative products that are not available in the US. But you've had the NASDAQ that has asked the SEC for permission to be able to offer tokenized shares, tokenized securities on the NASDAQ. And that's because of this wave of the entire financial infrastructure, which is expected to upgrade to blockchain. And they don't want to lose ground to platforms like Coinbase, like Kraken, like Gemini. This is a big market. Just to show you what one study shows is that real world assets, the market cap for real world assets is expected to go from 600 billion this year to about 19 trillion in 2033. And we're not just talking about equities. We're also, of course, talking about bonds, gold, real estate, any type of real world asset that you can think of. Now, why would you want tokenized equities? What is the benefit of them? Well, they can be more easily traded. There's faster settlement times. They can be split into smaller pieces, so you have more investors that are able to access these. They can be accessed from anywhere in the world, and they can also be used as collateral. I mean, I had one industry insider telling me you'll be able to even swap. Let's say you want to dump Alphabet and buy Tesla. You'll be able to do that in one move. You won't have to sell one, wait for the settlement, and then buy the other one. The goal is to eventually have stocks like Tesla, like Amazon, like the Mag 7, all issuing, those companies issuing their shares on blockchain. The challenges, of course, are that you have settlement processes that have to be changed, clearing processes that have to be changed. These are processes that can take days as far as settlement time. So all of that needs to be shifted, to be changed, and that is going to take some time. But this is definitely revolutionary as far as the financial market's concerned. In the end, everything is going to migrate. That is what Wall Street is betting on.
Thank you, Ines. Appreciate it.
Thank you.
Apple unveiling a new line of iPhones at its annual product event. Yahoo Finance's tech editor Dan Howley got his hands on the new phones to give us an in-depth review.
The next generation of Apple iPhones are here. They include the iPhone Air, as well as the standard iPhone 17 and iPhone 17 Pros. It's been about 8 years since Apple launched the iPhone X in 2017, and since then, the design of its big-time phones have kind of stagnated. Sure, they've updated the inside with new chips and made the cameras better, but really the look and feel of the phones has remained mostly the same until now. There's a ton of big deal changes to this, but there are also a few trade-offs, so let's go through them. This is the iPhone Air. It is the latest iPhone, new design, incredibly thin at 5.6 millimeters and incredibly lightweight. Now, I know those numbers might not sound big, but when you hold them next to something like the iPhone Pro Max, it really does feel like a different kind of device. Inside the phone has Apple's new A19 Pro processor. Basically, it's the latest version of the chip that runs in all iPhones. The Air, unlike the Pro or the standard iPhone 17, has just one rear lens. So it's not as though that's bad, but if you're the type of person that really likes to get a macro shot or really zoom in, that could be a deal breaker for you. On the 17, we have a standard zoom as well as an ultra wide, and then on the 17 Pro Max, we have a new 8x telephoto zoom, which is the furthest that Apple's offered so far. And then up front, they have what's called a new center stage camera. Now, the big deal here is that unlike prior versions of the front-facing selfie camera on the iPhone, where you had to kind of turn it sideways to get a vertical view, or rather a horizontal view, this does it automatically. So you can just press a button and it'll immediately turn to landscape. It's got a good, decent amount of battery life, but the problem is that the 17 and 17 Pro also get big updates for their battery life, and they're going to last with the 17 Pro Max up to about 39 hours. One of the other things that I think is worth pointing out is all of these phones now come with Apple's iOS 26 and their new liquid glass design. Finally, pricing. Let's talk about that. The standard 17, that starts at $799 still, no difference, but you do get 256 gigabytes of memory, up from 128. The Air, that starts at $999. So not exactly going to break the bank for a new design. Very cool to see that. It's slightly more expensive, though, than the Plus was, which the Air replaces. The Pros, though, get a little bit more expensive at the start. Instead of $999, it's now $1099 for the base Pro and $1199 for the Pro Max. So not as much change as far as the pricing goes overall, but it's definitely something to keep in mind. From my experience, I really like the Air. I think the photo quality is great. I thought the battery life was great, especially compared to last year. Basically about the same performance. So overall, it's a big moment for Apple. They're finally changing the design of the iPhone. And if they follow the same pattern that Samsung did, they released a super thin phone and then released a super thin foldable. There have been rumors for a long time that Apple's working on a foldable, and it just released its first super thin phone. So now we just have to see if there's a foldable in Apple's future.
Stick around, more Asking for a Trend still to come. The job market is especially tough for recent college graduates right now, but a new study is showing the cities where hiring is happening. JLL's latest Talent Hubs report finds graduates are getting jobs in big cities like New York and San Francisco, while Sunbelt cities like Dallas are climbing in the rankings. Joining us now for more, we have John Gates, JLL America's CEO of Leasing Advisory. John, it's good to see you. So the report here, we're looking at cities attracting those new graduates. Before we get to the actual cities, and I want to run those by you, John, what are the big drivers here that you saw for Talent Hub growth?
First of all, thank you very much for having me, Josh. Glad to be here. The big drivers, we've seen a meaningful uptick in venture cap investments and spending, and you have a couple big hubs, Northern California, obviously, and then New York has become a very large hub for that. And so you see sort of small cap and mid cap tech job growth, which has been big. The financials have been hiring. And so we've just seen an improved environment overall for college graduates, although very recently it's slowed a little bit.
Let's get into some of these cities, John. Let's see who makes the list. So it looks like your report shows San Francisco jumping back, it looks like, John, to the number 2 talent hub. What is driving that, John, and is it sustainable?
Well, I think it probably is sustainable for some period of time, although tech certainly is volatile. That is AI growth. The venture caps are funding a lot of new startups. You're seeing, B and C rounds, and just so there's job growth there and exciting activity. And I think that's an exciting space for young people as well, getting out of college. And obviously, you've got a lot of universities on the West Coast. The other thing I would throw in is young people getting out of school have wanted to go to large cities to start their careers for a long time. They now have an opportunity to because there are jobs available.
Here's another one I want you to take on, John. Dallas, Fort Worth. It looks like it, John, has been the top corporate relocation destination for 5 years running. What explains that trend?
You know, Texas is a pro-business state. It's a reasonable cost of living state. It's a low tax environment state. And so, yes, we've seen many corporate relocations, small mid-cap businesses and Fortune 500 companies have moved here. And then beyond the headquarters relocations, I'm sure you've seen the Y'all Street phenomena, if you will, where large financials have been moving very large numbers of jobs here as well, although probably not headquarters. So we have been the beneficiary. I live and work out of Dallas. We've been the beneficiary of tremendous high quality job growth here. And I think it's for typical, business fundamentals, high quality labor here as well.
What has it meant for real estate demand in that area, John, specifically?
It's been very good in the office market at the top end of the market. All these jobs and companies that are coming here generally want newer office stock that's very well located. And as you would know, Josh, very highly amenitized. So lots of things to do to make the building seem intriguing and exciting, street level activity and plenty of places you could walk to. It's the same things we're seeing in other big cities as well. Dallas, again, throws in the quality labor at a reasonable price point, quality housing, quality education, low taxation, low regulation.
Any kind of, let's say, relatively affordable markets, John, you'd have your eye on that could maybe break into the top 10?
Well, I still think you see expansion across the South. There just tend to be more affordable than the urban densities in the northern half of the United States. So I think Raleigh, Durham is one. Charlotte continues to grow. Atlanta's not exactly a sneaky market, but I think a lot of growth there. Nashville, Phoenix continues to grow. Austin. So I don't know that I have a news story there for you, but a continuation of a story that's been happening for a little while here.
Well, if you were to look at this report, John, talked about what it means for different groups, for investors who are listing, what would be the big takeaways?
Well, if I was a real estate investor, then I would be looking at markets that have positive net absorption and leasing growth. And it tracks very closely with those. New York has been very strong for the last 2 years. Northern California had a dramatic increase, especially in the city, starting last year, and it's continued this year. Dallas has done well this year. And so that's a good place. Probably office is an out of favor asset class for sure because of the flight to quality, and maybe there's a real opportunity there.
Finally, John, given your area of expertise, I got to get your take on the Fed decision today. What'd you make of what you saw and heard?
I think down the middle of the fairway, it's what we expected. I would have been a little more surprised by a larger move at this point. This Fed has shown us that they will be methodical, I guess, and somewhat conservative and not bold in making big decisions. So I think it was about what we expected.
John, always good to see you. Thank you.
Great to see you. Thanks again for having me.
That's a wrap on his Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wealth. Have a great night.